Hello, I'm Donald Leggett and welcome to the latest financial interview brought to you by London Southeast. Our guest today is Mr Davidson, CEO of Trident Resources, share ticker TRR, a mining royalty specialist who were listed on the London main market and are soon to be listed. They're in the process of moving to AIM. So welcome, Adam.
Hi, thank you.
Yep, you're joining us from Denver, Colorado today. Thank you very much indeed for your time. I think the obvious place to start is tell us about the Trident business. Quick overview of Trident.
Yep, yeah, sure. So Trident, it's currently listed on the LSE, a standard listing, as you said. It was originally set up to acquire a mining asset, but then over time, the board and advisors involved in Trident, they saw an opportunity in the mining royalty space, specifically an opportunity to establish a growth-oriented company to acquire and ultimately build a portfolio of broadly diversified royalty assets, which over time, as the portfolio grows, will give investors exposure to the full suite of mining commodities, such as nickel, zinc, copper, gold, iron ore, and so on, which is an offering that at the moment can't be found on any exchange, as the majority of royalty companies are predominantly, if not exclusively, focused on precious metals. So myself and my colleague in Australia, Trident Resources, joined Trident in late 2019 in order to execute on the strategy, with the announcement last week representing our first royalty acquisition.
Okay. For the uninitiated, could you explain in simple terms what mining royalty assets are and why Trident find them such a particular sweet spot?
Yeah, sure. So at a very high level, royalties are a financial instrument in which the royalty company or the royalty purchaser provides upfront capital to the mining company in exchange for a percentage of future revenues or profits. Of course, there can be sort of endless variations of this, but all royalties typically follow this basic structure. And now the other asset class we're pursuing, which is mining streams, is similar. Except in exchange for that upfront payment, the owner of the stream receives a portion of production at a fixed price.
And the miners like this because it's an alternative route to financing.
Absolutely, yeah. I mean, you can look at the environment we're in today, and if a miner is confident in their business and their share price has just dropped 50%, but they don't want to go out there and raise equity, getting debt, is always a challenge without a producing asset. So royalties and streams offer, sort of an ideal source of funding. With regards to the universe of available royalties and streams, there's literally thousands of them out there in existence today, in addition to the new ones that you can then write, to fund companies ongoing.
Before we quite get on to your first deal, talk us through funding to date and your plans to raise capital going forwards. Talk me just at a broad brush. What does the balance sheet look like, and how is it all going to work?
Yeah, so when the company was originally listed in 2018, there was a financing that was done alongside where they raised, I think it was just a touch over £4 million. And really that's what the company's been surviving on since that time. We've got a very low burn rate, as you'd expect. And Trident hasn't conducted a fundraising since then. That said, we're conducting a fundraising alongside the relisting on AIM, which is intended to allow us to execute on some of the transaction that's in our pipeline, as well as build a bit of a war chest to go out there and make some smart acquisitions. I think, as you can imagine, the recent turmoil has been sort of painful for everybody, but from our perspective, it provides an opportunity to go out there and put some capital to work. So we intend to raise approximately around 20 to 30 million US.
Well, that's a serious amount of money you're raising.
No, that's right, and we've got some pretty large, substantial shareholders, the likes of some of our biggest shareholders, Lim Advisors, the fund out of Hong Kong. We've also got on the register Regal Funds out of Australia, Precision Funds, Nero Resources. So groups that got into the original vehicle with the intent of, if they like the opportunity that comes down the track, of either upsizing their position or funding pro rata. So we've got a good sort of base to lean on, as well as going out to potential new investors.
And the reason that royalties are a sweet spot for you guys is that the ratings of the listed companies are higher than for miners. Is that correct?
Yeah, no, that's right. There's a lot of historical data that sort of points in this direction, and a lot of that's driven by, if you use a simple analogy of you can buy a miner that is producing 100,000 ounces from their single mine, or you can buy a share of a royalty company that's got a portfolio of assets. that, collectively have an attributable 100,000 ounces of production. One's got that single asset risk. If there's a wall failure, for example, production stops. Whereas if the similar thing occurred on a royalty portfolio, but it's spread across 20 different assets in 20 different jurisdictions, it mitigates the risk to a large extent. So you see some of the larger precious metals focused royalty companies in particular sort of traded multiples of sort of 20 times on EV EBITDA and sort of 1.5 to 2 times with regards to NAV.
Okay, interesting. So let's focus on Australia. You've just taken on an iron ore royalty. You acquired that a few days ago. What were the terms and when those revenues start to accrue? And talk me through why it's exactly the sort of thing that you liked as a management team.
Yeah, sure. So very high level, it's a 1.5% FOB royalty, which means we're paid on revenue, just excluding shipping from that calculation. And it sits over a portion of Mineral Resources, Cooley-Knobbing iron ore operation. So one of the very appealing things for this being our first acquisition is it is an operating mine, and the royalty is currently paying. So the last quarterly royalty payment for Q4 of 2019 was around 730,000 in Aussie dollars for the quarter.
Okay, so what would the next steps be for Trident? We've dealt with lots of the name changes and so on and the relistings. But in terms of what are you looking at the moment, and what are your next announcements going to be?
Yeah, so the intent, when I was giving you that illustration of why a royalty company gets this sort of valuation uplift relative to a comparable miner, that really comes down to critical mass of the portfolio. So we've done the first acquisition, which is great. It gives us some cash flow, and it's on an asset that's operated by a major, and they just allocated 120 million to ramp up production. So it's got some really good things, but then the key is to go out there and do more of that, because, to be able to do things like get leverage against the portfolio, so you can go out there with cheap debt and buy other royalties, and the ability to pay a healthy dividend. All that comes from, from having a portfolio of royalties, as does obviously the valuation uplift. You don't get that from having one or two, you get that from having sort of 10 to 20.
Would you say clearly that your intention is to become a mid-cap?
Oh, absolutely. Yeah. If we're not at a sort of $100 million market cap within a couple of years' time, I think we'd all be disappointed. And the intent is to grow this thing into being a $500 million company, sort of in the 4 to 5 year time frame. And there's actually quite a few precedents for this, not particularly from the diversified space, which is what we're looking for. We want to have sort of every commodity represented within the portfolio over time, but there have been quite a few precious metals royalty companies.
So you're going to be diversified, and you're in London. Okay, so another way of asking the same question, but why is that the sweet spot for you guys?
Yeah, so I have a few reasons for that. So, well, one is the AIM obviously gives us access to different pools of capital than the sort of 16, 17 listed mining royalty companies in Toronto. Because to be clear, there's only one in London, Anglo Pacific, currently. And in Australia, despite the presence of hundreds of royalties, there's no mining focused royalty company. There's a couple of oil and gas guys that have the odd mining royalty, but there's no dedicated mining royalty company in Australia either, which is a bit of an anomaly that they're all sort of concentrated in Toronto, despite the fact that they get these healthy valuations and they can get leverage and do all these sort of great things. They just haven't proliferated yet.
Okay, we've heard about the positives. So if you could talk me through the pitfalls, what can commonly go wrong in mining royalty transactions? You know the space, what can go wrong?
Yeah, sure. Well, so the mining royalties do share some similar risk to equities. So, commodity price exposure is an obvious one. Underperformance of the assets production is another. Cost blowouts are less direct because they don't impact the royalty unless it results in the asset ceasing operations completely. But outside from that, it's slightly different. I suppose the most common potential pitfall is a royalty company goes out there, puts a royalty over a development asset with the expectation that that asset is brought into construction sort of in the next 2 to 3 years, only to find themselves 5 to 6 years later, and they're still waiting for the asset to come into production.
Does that happen a fair bit in your world?
Yeah, it does happen. I mean, permitting in various jurisdictions can be incredibly opaque. And then as soon as you're permitted, you need to raise the money, and things like what we're seeing happen now can derail plans all the time. So it's you have to sort of build that into your modeling. But unlike equity, over the same asset, it would be suffering dilution over those 5 to 6 years while the company's raising money to keep itself afloat. Whereas a royalty, once it's in place, it would just be sitting over that asset, and when it does come into production, then it starts to collect.
Okay, you said there's thousands of assets out there. Give me a sense of some of the ones that you like, and maybe just give me a case study example of a couple of them, and explain why it is that you particularly prefer those and what the positives are.
Yeah, the first thing we like to look at is a solid operator, so they can vary, from being a private company that has never built or developed a mine before up to a major that operates dozens of mines. In the case of the royalty we just picked up, it's operated by Mineral Resources, which is, I think, a plus $2 billion Aussie market cap company. So they've got a lot of firepower. They've also got over $1 billion in cash from a recent asset sale. So, something like what we're seeing today with coronavirus, they're well positioned to sort of wear any short-term pain. They've got the cash. The other thing is probably the robustness of the asset. Pretty clearly, we need to do all of our technical due diligence on the geology, the processing risk. In this case, we liked it because the geology is pretty straightforward. It's a pretty contiguous ore body.
Why would they need your money? Why do MinRes need your money?
No, yeah. So in that case, they didn't. MinRes wasn't the owner of the royalty, and this is actually, one of our sort of key initiatives is to try to go out there to parties that have royalties and acquire them. So in this case, it was held by a junior company.
There's a secondary market for these things.
No, that's right. Yeah. So the company that held this particular royalty, they'd had the property, sort of 10 or 12 years ago, several iterations ago. They'd moved on to another property and then another and then another. But as miners often do, they'll retain a royalty over that property, a bit of a saving exercise if it does go into production, or to keep a sort of lingering interest to the asset. So what you had is a small Aussie junior that had this royalty from an asset from years ago. Lo and behold, it started paying. And then, it's really up to them. Do they want to sort of sit there, let the cash collect so that they can have enough to then go out and execute a meaningful drill campaign on their core asset? Or do they just monetize this core asset or this non-core asset upfront, knowing they're taking a haircut, but, monetize it, gets the cash in the door for them. They can go do what they want to do on their current property. And we're acquiring these assets as a single non-core asset from one company. But as you start to pull these into a portfolio, you obviously get that uplift. And you see it in the case of the big precious guys that get valued at 1.5 times their NAV. They can pay full value for royalties, pay 1 times NAV, but then as soon as it's in their portfolio, it's getting valued on 1.5. So, that's sort of the progression that we'd be wanting to get to, or is getting that critical mass so that we can enjoy that sort of uplift.
Absolutely fascinating. Okay, Trident Resources, soon not to be Trident Resources. Tell me what the next 2 years hold.
Yeah, so I think for us, it really is that matter of acquiring more royalties and building the critical mass, because as soon as we get to that stage, then I think you see that, you see that natural sort of pivot, that inflection point where the portfolio has enough substance to it. You can get sort of meaningful debt. You can start paying a meaningful dividend. Maybe we do relist again on the LSE. Maybe we get a secondary listing on the TSX or ASX. And then I think at that point in time is when you would see a lot of the sort of big, the Fidelities of the world that would come onto the register to get their exposure to mining commodities from a dividend royalty portfolio, rather than, because there are other options, are to buy shares in sort of a BHP or a Rio to get diversified miner exposure, but then they're exposed to a miner, versus sort of similar risk profile, but from something that's got a little more growth potential.
Okay, it might be a little bit spooky for investors, because you're actually your shares are suspended at the moment. So I suppose my last and a very important question is news flow in the next 6 months, and when would you expect to be relisted?
Yeah, so we're pushing aggressively to get this relisting behind us, for a couple of reasons. As you can imagine, it would be nice to have the logistics and admin of that work stream behind us, but more importantly, we'll be raising financing, obviously, in conjunction with the relisting. So, we're targeting before the end of May to be on AIM, have raised some capital, and from there we can sort of pivot back to focusing entirely on acquiring royalties. And to that end, with regards to news flow over the next 6 months, we've got a really robust pipeline. in fact, at times overwhelming sort of pipeline of opportunities that we can look at. And now that we've made this announcement last week and we can sort of be out there in the public as a royalty company, we're just, as you'd expect, particularly in this market, sort of getting inundated with new opportunities. So I don't doubt that we're going to have a fair amount of news flow as we use the cash that we raised to go out there and continue to get some more royalties.
Adam Davidson, that's it for now. We're out of time. Thank you so much for joining me from Denver, Colorado. You're the CEO of Trident Resources, soon to be Trident something else. And I'm very grateful for your time. If you like that interview, please do subscribe to London Southeast YouTube channel. And my final thought in these coronavirus times, stay safe. Thank you.